1 2, check check, 1 2.
Hello. Hello and welcome. My name is Stephen Schaefer, and I am the director of the Federalist Society's Regulatory Transparency Project. We are happy that you have joined us for today's event, the new crypto ecosystem, necessary regulation, or crippling future innovation. We look forward to remarks today from SEC Commissioner Hester M. Peirce and the panel to follow. Check out future events and content at regproject.org. That's regproject.org. First, I would like to introduce today's moderator, J.W. Verrett, who is the chair of the Regulatory Transparency Project's Financial Services and Corporate Governance Working Group. J.W. is an expert in banking, securities, and corporate law. He teaches on those topics at the Antonin Scalia Law School at George Mason University. He is a graduate of Louisiana State University, Harvard Law School, and the Kennedy School of Government. I encourage you to read more about all of JW's many contributions and accomplishments online at fedsoc.org. JW, I will now turn it over to you.
Thank you. Appreciate that. As I introduce today's discussion, I want to ask a question. Open with a quick question. Why do we care about cryptocurrency? Why do we care? Do we care because it's the next big thing? Do we care because of the celebrity endorsements, Super Bowl ads? No. Do we care because it's the next thing to speculate on, and we like when number goes up? A little bit, yes, absolutely. But let me submit that the reason why at least I care, and why I think we should care, is because of the central tenet of this new burgeoning industry, which seems to me to be that decentralized computing power can translate to decentralized economic and political power. If economic transactions or communications can take place in a peer-to-peer way, of course peer-to-peer predated crypto, but now blockchain applications can really make it sing. If economic transactions can take place in a way that is computed across decentralized computers, thousands of them across the globe, then there is no central party that can stop that transaction from taking place, that can censor economic transactions between willing parties, or that can charge economic rents for the privilege of doing so. And when that decentralized computing power translates to decentralized economic and political power, it empowers the individual. And in that way, I think FedSoc has a lot in common with crypto, actually. First of all, FedSoc operates in a decentralized way, right? We're a decentralized group. The practice groups create the programming. Gene and Dean are here to help facilitate, as they'll probably tell you. And they do a great job. And by the way, thanks to all of our FedSoc team here for helping set this up. But that's how they operate. But even more importantly, let's remember the book we all revere that FedSoc's named after, the Federalist Papers, is a book about decentralized power, isn't it? It's a book about decentralized power at the federal level, separation of powers, keeping all three branches in check. And more importantly, it's a book about the decentralization of power through recognizing the states as sovereign in the constitutional structure, the states as laboratories of democracy, laboratories of economic invention. I think the founders today would have loved crypto if they were alive. No question, but that Ben Franklin would have a crypto project he'd be hawking in the tavern in Pennsylvania. No question, but that Thomas Jefferson would have some crypto application for agricultural processes or for trade. Alexander Hamilton would have been all over. He would have had a crypto exchange, right? Or a crypto bank. So I think all of these things are fascinating. Now, what's the threat to crypto right now? That not all projects lived up to that ideal, right? Some of them are very centralized. Some of them are very centralized scams. Some of them are centralized earnest attempts that have horrible operational security and a lot of hacks. Believe me, I know about all of these because I've been a prolific investor in many of them. On the other hand, so what's to do about that? On the other hand, I teach the 33 Act, the Securities Act of 1933. It's the one thing I know a lot about. Simple cookie-cutter application of the 33 Act to crypto brings on some incredibly ridiculous consequences. We laugh about it in securities class. My students laugh about it. Treating a kid running a miner in their basement or a validator in their basement is treated like an underwriter for the purposes of the securities laws. The same regulatory regime for JP Morgan will apply to that kid in their basement. Utterly ridiculous. So what's to be done about this? How to balance investor protection with investor innovation and investor freedom to help to facilitate this movement that's all about decentralization of power. I know of no one in the world who spent more time thinking about balancing that balance with more technical skill, with more commitment to both investor protection and investor freedom and opportunity than Commissioner Peirce. That's why it's my great privilege to introduce her today to today's discussion. We'll have a discussion panel that follows. Those in the audience, get ready. The Commissioner loves to take a few questions. Our panel will love to get a few questions as well. Commissioner Peirce needs no introduction. She's been around FedSoc events for a while, but I'll just offer. Before she served on the commission for a number of years and has been a thought leader on cryptocurrency regulation through dissents and speeches and in a number of venues. She served as a scholar at the Mercatus Center. She's been counsel to the Senate Banking Committee during the Dodd-Frank Act. She's been counsel to Commissioner Atkins and counsel in the SEC for over a decade. Let me stop talking here because you know who we're here to listen to. Please join me in welcoming Commissioner Hester Peirce.
Thanks, JW. I think it's nice to have that kind of broad overview. I'm going to be talking about a much more specific issue today, and so I think it's good to bear in mind that broader, more conceptual framework. And I want to thank the Federalist Society, the Regulatory Transparency Project, for the chance to be with you all today. The topic of today's event is regulating the new crypto ecosystem. And that's certainly a very hot topic of conversation in Washington these days. And it reminds me of this book. It's a children's book, but it's a book called Are You My Mother? And it's about a little bird who the bird hatches. His mother's run out or flown out to go pick up a worm for him. And so when he hatches, he's there all by himself, no mom. And so he hops down from the tree. He doesn't know how to fly yet, so he's walking around and checking in with different potential mothers. And so first, goes up to a cat, and the cat says, I'm a cat, I'm not your mother. Goes to a dog and a hen and a cow and even a front-end loader. No mom. The front-end loader does him the service of putting him back in the nest. So when the mom comes back, baby bird and his actual mother are reunited, and he knows right away that's his mom. So the crypto industry is on a similar journey. It doesn't seem to be in need of a mother, but it is out looking for a regulator. And I feel like it's a similar search, keeps going up to different regulators and asking, are you my regulator? But there's a bureaucratic twist on it. It's Washington, right? So of course every regulator says, oh yeah, I'm your regulator. So everyone is claiming to be the regulator of crypto. And so crypto is looking to Congress to kind of sort these things out, figure out who is actually the regulator. And there was a bipartisan bill that got a lot of attention last week, was introduced, and it attempts to answer that question. Some people in the crypto industry are celebrating because they like the allocation of power in that bill. Certain authorities are at the SEC, but certain other authorities are at the Commodity Futures Trading Commission. And a lot of people are happy that more of the authorities didn't end up at the SEC because they've been really disappointed at how my agency, the SEC, has interacted with the crypto industry and has regulated crypto. And I understand and share that disappointment, but I'm hopeful that we can change course and use our existing authorities better, and any authorities that Congress might give to us through new legislation, I hope that we'll use that authority better as well. Watching the SEC refuse over the past 4 years, which is how long I've been there, to engage productively with crypto users and developers has prompted feelings of disbelief at the SEC's puzzling and, I think, out-of-character approach to regulation. The Commission, of course, has occasionally explained its actions or its inactions, but those explanations have often been confusing, inconsistent, and unhelpful. I've communicated my discomfort with the Commission's behavior to my colleagues, to the public, and the results to date seem to be about the same as they've been over the past 4 years, which is poor. We continue to brush off the crypto products and services without a consideration for the consequences of what we're doing. And so I want to talk about one concrete example today, and that's the Commission's persistent refusal to approve a spot Bitcoin exchange-traded product. But of course, I've got to give you my disclaimers before going any further. And so the first is the standard disclaimer that I always give, which is that my views are my own views, not necessarily those of the SEC or my fellow commissioners. But I want to give you some other disclaimers too. This speech is not an endorsement of Bitcoin, Bitcoin exchange-traded products, or any other crypto-related asset. People exercising skepticism great enough to quell the dangerously seductive fear of missing out, JW, that's for you, should choose what to put in their portfolios when and in what quantities. Whether assisted by a financial professional or flying solo, investors should invest based on factors such as their own present and anticipated future circumstances, informed risk assessments of the assets they're considering buying and the portfolio in which those assets will sit, and a candid assessment of their stomach for market volatility and financial loss. They should be aware, as recent events have reminded us, that past performance is no guarantee of future performance, and people shouldn't look to regulators to make decisions for them, and regulators should not seek to play that role themselves. My third disclaimer is that although many of the early Bitcoin exchange-traded product denials were issued by the staff under authority delegated from the Commission, my criticism about these denials and about other policy decisions are leveled at the Commission and not at the staff. The staff is appropriately following the lead that it's getting from the Commission, but the Commission has not been leading well. The Commission's resistance to a spot Bitcoin ETP is becoming almost legendary. When is the Commission going to approve a Bitcoin ETP is the most common question that I've gotten in my entire tenure at the SEC. It continues to be the most frequent question. And my answer has tended to be, a disappointed, I have no idea. The Bitcoin is a relatively new asset, but the concept of affording access to commodities through an exchange-traded product is not new. The Commission long has allowed investors to gain exposure to a number of non-securities instruments through pooled investment vehicles, and that's been a boon to investors as their shares trade continually on national stock exchanges at market prices, much as a regular stock would trade. Through a process of creating and redeeming shares of the fund, institutional traders called authorized participants play an important role in keeping the price of these shares in line with the price of assets in the investment pool. The Commission has added crypto-specific hurdles to what used to be fairly straightforward processes for approving these pooled investment vehicles, whether exchange-traded funds under the Investment Company Act or exchange-traded products under the Securities Act. Indeed, although in the past 8 months, both ETFs and ETPs based on Bitcoin futures have made it through, the Commission has continued to disapprove ETPs based on the spot Bitcoin market. The reasons for this resistance to a spot product are difficult to understand, apart from a recognition that the Commission has determined to subject anything related to Bitcoin, and presumably other digital assets, to a more exacting standard than it applies to other products. In a 2018 letter, for example, the staff in the Division of Investment Management expressed a willingness to engage with fund sponsors interested in incorporating crypto assets into their funds, but it outlined, quote, significant outstanding questions concerning how funds holding substantial amounts of cryptocurrencies and related products would satisfy the requirement of the 1940 Act and its rules. Those questions related to custody, valuation, liquidity, the arbitrage mechanism for ETFs, and manipulation and other risks. Asking these questions isn't inherently problematic and might even be characterized as positive because it sparks thinking about really important questions. But the Commission gave very few explicit external indications of progress on grappling with these issues, let alone resolving them. Retail funds that tried to incorporate exposure to Bitcoin into their portfolios encountered a series of challenges. The disclosure review process plays an important investor protection role, but the Commission has many polite ways of exercising merit regulation, often without a clear legal basis for doing so. Certain funds looked for ways to get exposure to Bitcoin for their investors, such as holding over-the-counter products, companies with crypto exposure, or putting small sleeves of Bitcoin futures into their portfolios. Closed-end funds, which don't provide daily redemption, were the first to be able to incorporate Bitcoin futures. But even as late as May 2021, the staff reminded closed-end funds seeking to invest in the Bitcoin futures market to consult with the staff prior to filing a registration statement about the fund's proposed investment, anticipated compliance with the Investment Company Act and its rules, and how the fund would provide for appropriate investor protection. Now, this is unusual because there's no requirement that you seek approval before you make a filing. And with respect to open-end funds, the statement warned that the staff would monitor the quality of the underlying Bitcoin futures market and funds' ongoing compliance with the Investment Company Act and the rules thereunder and the other federal securities laws. Again, this is very unusual because you've got to remember when you file something, what the SEC is looking for is they're looking to make sure that your disclosures match what you're actually doing. But here, the Commission was taking a step beyond that, and it's saying it's watching what's happening in the markets. Again, not a problem that it's watching what happens in the markets, but what my issue with what was going on, it was an attempt to step into the shoes of the marketplace to assess whether a product would work. Then we've gone too far. That's up to the market to decide. We just have to make sure the disclosures are right and then let the market figure it out. Although a number of funds managed to hold Bitcoin futures, many sponsors wanted to provide exposure to Bitcoin in an exchange-traded form. The Commission continued to signal to would-be sponsors of such products, don't file. In October 2021, however, everything changed. The SEC finally allowed futures-based Bitcoin ETFs to start trading. And what made that change? Well, Chair Gensler gave a speech in which he gave a signal saying, I think a product under the Investment Company Act with futures, Bitcoin futures in it would be okay. And he cited the fact that the CFTC oversees the futures market and that this Investment Company Act, these Investment Company Act protections that come with an ETF would make him comfortable. And so some of these funds started trading, they proved popular, but demand for a spot-based product continued to be out there because fund products, futures products are more expensive and difficult to manage, and they don't necessarily track as closely the spot price. So until this year, all of these products, the futures exchange-traded products, were under the Investment Company Act, which is the one that has these protections for investors. And in April, there was a new development, which was that the Commission approved the first ETP holding Bitcoin futures under the Securities Act. And so that implicitly acknowledged that the protections afforded by the Investment Company Act are not relevant to the question of whether approval under the Exchange Act is appropriate. The protections the Investment Company Act affords are, as industry commenters have highlighted, designed and intended to protect investors against self-interested managers. It really has nothing to do with how the product trades. In other words, as another commenter described, the 1940 Act's protections do not address and thus are not relevant to the concern the Commission has repeatedly invoked when it's denying spot-based Bitcoin exchange-traded products. And those concerns are market manipulation and fraud in the underlying Bitcoin market. Some observers found this development a notable development because spot-based products would be also under the Securities Act rather than the Investment Company Act. But the Commission still has not approved any ETP based on the spot Bitcoin market. Despite the success of futures-based ETP applicants over the past 8 months, using the same tired reasoning, the Commission keeps denying spot Bitcoin ETPs. The Commission requires an applicant, which is the exchange on which the ETP is going to trade, that applicant has to come in and show that its proposal is consistent with the requirements of Exchange Act Section 6b-5, and in particular, with the requirement that the rules of a national securities exchange be designed to prevent fraudulent and manipulative acts and practices, and to protect investors in the public interest. In demonstrating consistency with Section 6b-5, the exchange applying to list the ETP has a choice. It can either show a surveillance agreement or a unique resistance to manipulation. The first option is for the exchange to show that it has a comprehensive surveillance sharing agreement with a regulated market or a group of markets of significant size. An acceptable surveillance sharing agreement would provide for the unimpeded sharing of information about market trading activity, clearing activity, and customer identity. Significant market size is determined, for example, by showing a reasonable likelihood that a person attempting to manipulate the ETP would have to trade on that market to successfully manipulate the ETP. Only then would a surveillance sharing agreement assist in detecting and deterring misconduct. One way that a market could count as being of significant size is if it's reasonably likely that a person seeking to manipulate the ETP would also have to trade on that market to succeed in doing so, and if trading in the ETP would be unlikely to be the predominant influence on prices in the market. So this is all very technical, but this is the kind of procedures that people have to get through. So another option would be the exchange seeking to list the ETP could show that the underlying Bitcoin markets are uniquely resistant to fraud and manipulation. The standard requires a level of resistance higher than what exists in traditional commodity markets or equity markets. According to a majority of the Commission, no exchange successfully has made the case under either approach. An ETP disapproval order issued last month embodies the now standard rationale. The exchange here opted for alternative 2, showing that the Bitcoin markets are uniquely resistant to fraud and manipulation. And the Commission said, as with the previous proposals, the Commission here concludes that the exchange's assertions about the general liquidity, growth, and acceptance of the Bitcoin market do not constitute other means to prevent fraud and manipulation sufficient to justify dispensing with the requisite surveillance sharing agreement. While the exchange states that the significant liquidity in the spot market and resultant minimal impact of market orders on the overall price of Bitcoin mitigates the risks associated with potential manipulation, such assertion is general and conclusory. End of story. The reasoning, though, underlying the Commission's denials of spot Bitcoin ETPs is, in my view, general and conclusory, which makes it difficult to know how approval could ever be achieved. The Commission doesn't really grapple with the important characteristics of these products and the underlying spot markets, including the widely distributed nature of trading in Bitcoin and the methods used by these ETPs to calculate the net asset value. It doesn't take into account the evidence from other jurisdictions where regulators have approved similar products. Absent a wholesale rejection of the standard analysis, how does the Commission put itself in a position where it could approve these products? With each new disapproval, the SEC doubles down on its reasoning. The continuing refusal of the SEC to approve a spot Bitcoin ETP is puzzling not only to me, but to many agency observers. The Bitcoin market has grown, matured, become more liquid, and attracted more and more sophisticated, in the TradFi, traditional financial market sense of the word, participants. At 13 years old, as of about an hour or so ago, which may have changed, Bitcoin has a market cap of approximately $430 billion and is trading at around $22,500. Bitcoin investors comprise natural persons and institutions, including regulated market participants. Many insurance companies, asset managers, university endowments, pension funds, large banks, and public companies have invested in Bitcoin or are considering doing so. Increasingly sophisticated infrastructure has built up around Bitcoin and crypto markets more generally. Like the traditional financial market landscape, The crypto terrain is dotted with trading platforms, trading firms, venture capital firms, hedge funds, law firms, and accounting firms. In contrast to 2018, when the Division of Investment Management noted there was an absence of custodians in the space, custodians now compete to offer their services. A cornerstone of institutional participation, the Bitcoin futures market, has been up and running since 2017, and that's a vibrant market now with open interest hovering around $1.7 billion. Spot ETPs have launched in other countries without incident, but with great investor interest. In Canada, for example, the first spot Bitcoin ETP reached $1 billion Canadian dollars within a month of its launch. Spot crypto ETPs are also popular in Europe, where there are more than 70 crypto ETPs with an estimated total of $7 billion in assets. ETPs in these other jurisdictions have functioned even in volatile market conditions. So why is the SEC a holdout? At what point, if any, does the increasing maturity of the Bitcoin markets and the success of similar products elsewhere tip the scale in favor of approval? Of course, the facts and circumstances of each application matter, but will I ever stop hearing that question that I keep hearing when a spot Bitcoin ETP? The approval of futures-based products, first under the Investment Company Act and more recently of a similar Securities Act product for listing and trading under the Exchange Act, might appear to open a door to changing the approach that we've taken. But the language of these orders provides precious little basis for optimism that the Commission will approve a spot Bitcoin product. The futures-based, and again, I don't have any insight, I'm just saying I'm reading the same orders everyone else is reading. The futures-based approvals turn on the regulated nature of the futures market, the CME, which is where assets held by the ETPs themselves trade. The Commission explains somewhat tautologically that the CME can reasonably be relied on to capture the effects on the CME Bitcoin futures market caused by a person attempting to manipulate the proposed futures ETP by manipulating the price of CME Bitcoin futures contracts. A little hard to follow, but that's kind of standard fare for these ETP approvals or denials. The reasoning obviously doesn't apply to spot-based products, and it's difficult to see how it's even relevant for an instrument that trades on hundreds of exchanges worldwide. It's true that in these approvals, the Commission reiterated its position that its concerns about the lack of a surveillance sharing agreement and filings seeking to list and trade spot-based ETPs could be addressed by demonstrating that there is a reasonable likelihood that a person attempting to manipulate the spot Bitcoin ETP would also have to trade on CME, which is the futures exchange. But the Commission also went out of its way to state that the evidence doesn't demonstrate that this type of connection between the two markets exists, an observation that wasn't necessary, it was kind of dicta to the Commission's approval of the futures-based ETPs. Perhaps the Commission could be persuaded that the similarity of pricing mechanisms for the futures-based product and the spot-based product undermines its rationale for treating them differently. The Commission's willingness to be persuaded, though, turns on whether the Commission's primary concern is legal and logical coherence with our approvals of Bitcoin futures products and other commodity-based products, and not, say, using the prospect of a spot Bitcoin ETP approval as an inducement to get exchanges to come in and register with us. Why does this matter? Investors might prefer a spot Bitcoin ETP to other options, and we ought to care about what investors want. This kind of product, depending on how it's designed, could enable retail investors to gain exposure to Bitcoin through a securities product that, because of the effective arbitrage mechanisms that go with this kind of exchange-traded product, likely would track the price of spot Bitcoin more closely. It likely would be inexpensive to manage such a fund, so fees would likely be low. It would sit conveniently in investors' brokerage accounts alongside other securities. It would allow investors to buy and sell their Bitcoin exposure the same way they buy and sell other exchange-listed products. Investment advisors also would find it easier to assist clients, and more investment advisors are hearing from clients questions and interest in Bitcoin. So it would help them assist clients as well who are seeking to get exposure. And it would do so through a product that they're familiar with. Some people might object to retail exposure to Bitcoin and thus might oppose a product that makes it easier for retail investors to get exposure to Bitcoin. Making it harder to access Bitcoin, however, does not mean investors will not find other ways of doing so. Some do, and of course can, hold Bitcoin directly. For the reasons I mentioned above, however, many investors want to get exposure to Bitcoin through the same way they get exposure to in other areas of their securities portfolio. They have several options for doing so, but the methods can be a less direct and more expensive way to get exposure to Bitcoin. So they can hold shares of a fund that has a small chunk of Bitcoin futures exposure. They can buy over-the-counter products that lack arbitrage mechanisms to keep the prices in line with underlying spot prices. They can buy a foreign spot-based ETP, which are generally unavailable or difficult for retail investors to obtain. They can buy a futures-based ETP, which again is likely to have some tracking difficulties and could be more expensive. So are we really serving investors by keeping them from a product that not only gives them the exposure they're trying to get, but does it in a way that is more convenient and perhaps less expensive? The Commission thinks those arguments are irrelevant. So other people might object to a spot ETP on the ground that its advocates stand to gain a tremendous amount when a spot ETP launches. And that is certainly true that many advocates of a spot ETP are Bitcoin investors who'd like to see the number go up. An ETP certainly could influence the price of Bitcoin, but Bitcoin markets do not always perform as people anticipate. A spot-based ETP, because of the ease with which it can be bought and sold, would be a way for many more voices to weigh in on the value of Bitcoin. Other types of ETPs have helped markets more efficiently incorporate information. Critics, therefore, can take comfort in the contribution that liquid, efficient markets play in working out the real value of assets, whether they are shares of a company, gold, or Bitcoin. Some Bitcoin hodlers might themselves object to the introduction of a Bitcoin ETP. One feature of a non-sovereign, censorship-resistant mechanism for storing and transferring value is its ability to function outside of the traditional financial system. Why drag it inside TradFi and thus expose it to the meddling of incumbent firms, financial firms, and the regulators that inevitably go with those firms? To these people, I say, the concern for liberty and personal autonomy that drives you to prefer fiat to fiat ought also cause you to reject a government arbitrarily limiting people's investment options. The Commission's reluctance to approve a spot Bitcoin ETP is a piece with its more general approach to building a regulatory framework for crypto using standard regulatory processes. Instead, the Commission has tried to cobble together a regulatory framework through enforcement actions. Enforcement is the appropriate tool to address the rampant fraud in the crypto space. But one-off enforcement actions that represent the first time the Commission has addressed a particular issue publicly are not the right way to build a regulatory framework. For that, Congress gave us other tools, including authority to craft tailored exemptions and notice and comment rulemaking. Enforcement actions shortcut the regulatory process. So take an example, the recent $100 million BlockFi settlement. That was a settlement that the Commission and a number of state regulators brought. The Commission's piece was $100 million. The Commission, in its settlement, set out a path pursuant to which BlockFi could register under the Securities Act and obtain an exemption from the Investment Company Act. The specific path laid out in that settlement agreement, crafted between BlockFi, one company, and the SEC, and keep in mind where the leverage was in that negotiation. If successful, that's likely to become the standard for regulation of crypto lending. Other crypto lenders, users of those services, consumer advocates, and other interested parties were not part of those negotiations, but the results will likely affect them. A preferable approach would have been, once we identified crypto lending as implicating the securities laws, to commence a rulemaking or invite crypto lenders to come in and discuss the appropriate path forward through careful use of our exemptive authority. We might similarly consider, rather than a reactive enforcement approach, a proactive regulatory approach with respect to non-fungible tokens, decentralized autonomous organizations, and decentralized exchanges. People doing things in crypto need to consider whether the laws, including securities laws, apply to what they do. For this to happen, though, in a more efficient and comprehensive way, the Commission needs to provide a level of clarity that has heretofore been absent. The SEC could think through issues with people in the crypto community with an eye toward achieving our regulatory objectives in a pragmatic but effective way. By doing so, we could both facilitate good actors' compliance and, importantly, inhibit bad actors much more effectively than we do through the resource-intensive, often delayed enforcement approach that we've taken so far. We have a number of suggestions and examples of how to proceed that we can draw from. My colleague, Commissioner Crenshaw, set up a special mailbox through which she solicited commentary about decentralized finance issues. Why not make that a commission-wide request for input? J.W. Verrett, in a recent petition to the Commission, recommended a starting point. Open a comment file so that people could discuss open questions about how to reconcile our securities laws with today's technologies. A small step, but a potentially important one. The Financial Accounting Standards Board, having heard a lot of concern about the current accounting standards for digital assets, recently opened a project to improve financial reporting for digital assets, including recognition, measurement, presentation, and disclosure. Another great example of the way to move forward in this area. A group of crypto lawyers has put together a number of concrete proposals, an iteration on a safe harbor proposal that I made, and also an exempt offering framework for digital assets that could be starting points for the Commission to engage with not only industry, but investors, advocates for investors, anyone else who's interested. We could have this open conversation. Recently, CFTC Commissioner Pham and I called for joint roundtables with the CFTC and the SEC. The two agencies have worked well together, sometimes not well, but sometimes we do have examples of working well together in the past where our jurisdiction bumps up against each other. This is another opportunity for us to do that. Congress is doing its thing, but we as regulatory agencies can be working together to give them a basis on which to consider how to move forward. And I think this would be an extremely productive exercise and one that would certainly capitalize on people's willingness to work with us. And I think that came through in a recent rule proposal, in the comments in response to a recent rule proposal we put forth. That was a rule proposal where people looked at it and they were concerned that maybe this isn't sort of an indirect way to regulate certain aspects of DeFi and crypto. And so people came in and they talked to us, and they by letter, they told us they're willing to work with us to figure out what the right approach is. But the right approach is not to adopt a rule without having the conversation that you need to have. People stand ready to work through myriad questions and regulatory concerns around crypto. Now all we have to do is extend them a hand. So I'll conclude with just saying, although I've been quite critical of the SEC's approach, I'm optimistic that we can change course. The agency just celebrated its 88th birthday last week. There's no better age than 88 to start grappling with difficult, interesting regulatory questions around crypto to keep our minds sharp. Regardless of what one thinks of crypto, it's in both investors and the SEC's interest to take a more productive approach. Using tools that Congress has given us and drawing on public input, we can provide regulatory clarity, facilitate iterative experimentation, and that's an important part of it because things are going to fail in this space. We all know that, but you got to let people try to iterate on what others have done and move forward that way. And together we can also pursue bad actors in the crypto space. Again, having a regulatory framework in place is really important because lawyers out there have nothing to point at but enforcement actions. They can't point to something to say, this is the way you need to do something. So I'm looking forward to the upcoming panel. I think we've got a great set of people on that panel who's going to be able to help us think through some productive steps forward. And I look forward to learning from what you all have to say. Thank you.
Anybody have any questions? Got a mic right here. Hey, Berlau, why don't you come? Yes. John Berlau, a FedSoc member, he's written a book on George Washington recently that you should all read. Talks about how George Washington used private money.
A recent column, too, on George Washington and crypto and how he used cryptography with the Secret Six, so he would also be fascinated about it, I think. Commissioner Peirce, it's always a pleasure to hear your lively and informative writings and speeches. By the way, I'm with the Competitive Enterprise Institute. I would... two questions. One is technical. My colleagues and I were just talking about just the definition of ETPs and ETFs. And in this space, so far, are all of the ETPs also ETFs, exchange-traded funds, because I don't believe the notes are there. And also, given recently what's happened with with Binance and Celsius and freezing redemptions on some of the exchanges where you buy the cryptocurrencies raw, what would be, I wanted to drill down a little about what would some of the investor protection benefits would have on having an ETP or ETF as an option. Are there guarantees of custody that they actually have to hold the crypto or whatever asset there is required by law? Not that it would guarantee against going down in price or anything, but that it would have to be there belonging to the investors in the ETP or ETF.
So to answer your first question, and this is complicated, people often say, when is there going to be a spot Bitcoin or a Bitcoin ETF is kind of the question. And what they're really asking is, when is there going to be a spot-based exchange-traded product? So an ETF, an exchange-traded fund, is something, it's a type of investment company under the Investment Company Act of 1940, which comes with a whole suite of investor protections. That's something that I actually like to point to that as an example of how long, I've said that our behavior with respect to crypto is uncharacteristic of the SEC, but there is a broader problem at the SEC in facilitating or setting the groundwork for innovation with respect to securities products. So exchange-traded funds were this huge innovation because it's like a mutual fund, but it trades on an exchange. So you can buy and sell anytime you want, and it's a really effective way of keeping the price of the fund in line with what's in the underlying basket. It took us 25 years to get a rule for ETFs on the books. There are a lot of other things that happened in the interim, but I think that's an example of how long some of these things can take. Anyway, so the funds that have been approved, the futures-based funds, most of them have been under the Investment Company Act, so they've been ETFs. Recently, there have been a couple that have gotten approved that are ETPs. These are funds that are under the Securities Act, and they do not have that suite of investor protections around them that an ETF would have. If there's going to be an approval of a Bitcoin product, it will likely be in the form of a 33 Act exchange-traded product. So to your question of what kind of investor protections does that afford, these are products that we have lots of experience with, and so they're disclosures around what the product is and how it operates, and so it's a tried and true animal. It's something that people are comfortable with. So that's why I think there's a lot of comfort. I'm of course not going to talk about any particular companies or projects and what's going on there.
But would there be? Not like any kind of guarantee the value, but that the promises as far as the keeping custody as far as.
Yeah, these are much more. They're institutional protections built around them that give the retail investor a lot of comfort.
Okay. Thank you. Thank you so much.
Thanks, John.
Madam Commissioner, thank you very much for being here. Cryptocurrencies have really taken off in a very low interest rate environment. We're now in a situation where interest rates are starting to rise. Every indication is that they're going to continue to go much higher, which raises this question. what are the regulatory challenges that would be posed in regulating Bitcoin and the other cryptocurrencies in a high interest rate environment, where for investors there's a relatively high opportunity cost of holding a non-interest bearing cryptocurrency, which in my opinion might lead some innovators to try and figure out some way of paying interest or something equivalent to interest on a cryptocurrency in order to retain investor interest in it. To what extent have you and others at the SEC started to think about how you will regulate cryptocurrencies in a high interest rate environment?
Yeah, I mean, it's an interesting question. I think the thing I will come back to is to say that our job is not to, tell you whether it's something that you should invest in or not invest in, although we certainly put out lots of warnings about the risks and volatility and so forth. But I think where it would come in is the question of how are you making disclosures around a product that has Bitcoin in it? What are the risks that you're laying out? And obviously there's a lot of thinking going around how you can make a crypto product that's interest bearing. I mean, there are existing products that are doing that now, but I think that's the answer. Is it would be through disclosure of risks rather than telling people they can't participate in products that have Bitcoin or other crypto in them.
All right, we have time for one more question.
Hi, Commissioner. You have, well, thank you for your talk today. You have also, in addition to being critical of the SEC about exchange-traded products, you've also been critical about ESG issues. And I was wondering if you saw any confluence of these two issues coming together. For instance, I could imagine the SEC putting out a rule about diversity requirements for exchanges or for tokens, or even sort of environmental disclosures related to proof of work for Bitcoin to sort of take that out of the marketplace and make everything else, make everything proof of stake. So I was wondering if you saw any confluence between ESG issues and the crypto market in general.
Well, I think the ESG term, environmental social governance, or everything that sounds good, can encompass so many different things, right? And so what I think you're putting your finger on is that, as in this area, where one of the things that I have tried to push back against in my role as a commissioner is merit regulation, because we're not a merit regulator. Some other securities regulators are merit regulators. We are not. That's not what Congress told us to do. And there has been, over my time there at the SEC, there have been numerous instances in which we've tried to use our authority that's designed as disclosure authority to be merit-based regulation, substantive regulation. And so I can see that we could use our disclosure authority in ways that would be designed to, get a focus on particular areas in crypto. The energy one is a common one that people talk about now. People think that energy shouldn't be used on Bitcoin mining, for example, and so you could use a disclosure rule to try to highlight it, but to actually try to stop people from using, from doing Bitcoin mining. And so certainly we're seeing that on the climate side, where we put out a proposal that is a disclosure proposal, but is certainly, at least appears to me, I should say. And again, we're in a comment period, so I welcome anyone's comments. Tell me I'm wrong about this. But when we put in the rule and we say, well, we realize it's going to be really hard to measure your Scope 3 greenhouse gas emissions, one solution would be for you to make a different product. The SEC, a disclosure regulator, is suggesting to people that they make a different product so they don't have to make a particular disclosure to us. That's a remarkable statement. And I think it's an area that people really need to be focused on. The misuse of a very effective disclosure framework to affect people's behavior substantively. That's just not our role. And if it does start to become our role, we're going to become a hyper-politicized regulator, and that breaks my heart because the SEC has a really important role to play in keeping capital markets functioning effectively. The capital markets in the United States are the best in the world, and there's a reason that they're the best in the world. And injecting politics into everything that we do is a terrible idea, and I hope that we're able to resist the urge, whether it's in the crypto area or in green finance or any other area. Markets are wonderful at solving problems. We just have to let them disclose what they're doing and then let them figure it out. They can solve problems in ways that we're as regulators, and even any one person in this room wouldn't be able to solve problems. It's when you put people together in the capital markets that you get the brilliant combination of the money and the innovative ideas. They come together and they produce things none of us could on our own imagine. So I will end with that note.
I think it's fair to say that crypto has a formidable tiger mom. So thank you, Commissioner, for that great discussion. Appreciate it. All right. Well, we're joined by a terrific panel today. The plan was pretty simple on my part. Just find the smartest people you follow on Twitter on crypto and just bring them all in a room and just kind of do a response panel to Commissioner Peirce's speech. And so we're going to go through, give each of our panelists 5 minutes to offer some introductory remarks. Then we're going to do another round of some back and forth. And then my hope is a significant amount of time for audience Q&A. So be thinking of some good questions. We've already had some great questions tonight. So first, this afternoon. So first, introductions. So to my right is Ryan Selkis. You can follow him on crypto as 2-Bit Idiot. Although to the contrary, very insightful, thoughtful, and his writings have been a big part of my crypto journey. His annual report is kind of the thing to follow on crypto, and he leads a firm called Messari, often described as the Bloomberg of crypto. He might agree that maybe Bloomberg is the Messari of traditional finance, right, Ron? Todd Phillips, to my left. Todd is the Director of Capital Markets and Corporate Governance at the Center for American Progress. Also a great follow on Twitter and a fun debating partner, discussion partner. I always learn a lot from Todd. Todd has a new report out with the Center for American Progress on cryptocurrency regulation across securities, commodities, and banking. Has a lot of provocative thoughts in there. Some things I want to debate with him further, but a report that I've learned a lot from and I highly recommend to everyone. Jerry Brito joins us. Jerry needs no introduction because he's been at every crypto event FedSoc has had over the last 10 years, but Jerry leads the Coin Center, the leading think tank in cryptocurrency regulatory issues. And not just, think tank is an incomplete description because Coin Center does a lot of things, and in fact just announced a new lawsuit against the Treasury Department over a new crypto-related reporting rule that was passed last year. So we got a terrific panel, and let me turn it over. Let's do a round each. Let's try to keep intro to 5 minutes. Ryan, go ahead.
All right, so I'm going to go first.
You're going to go first.
Oh, that was a little bit out of order, so we're going to start with the spiciest take, as my Twitter handle might imply. So I'm the only non-lawyer on this panel, which might relieve some of you, but I'm out of my depths in certain respects. I am an analyst, a longtime investor, and as JW mentioned, an entrepreneur. I've started a couple different companies within the crypto sphere. I'm actually intimately familiar with one of the ones that is immediately impacted by Hester's remarks, Grayscale, back when I was at Digital Currency Group. Worked on launching some of those products. More recently, my company, Messari, is a data analytics platform that some people call the Bloomberg of crypto, but we actually started with a little bit of a different mandate and called ourselves more of an Edgar-like repository, where we actually work on data standardization structures, disclosures, equivalents. We actually work with 30 of these open protocols on behalf of their communities to put together the equivalent of bottoms-up quarterly reporting for these assets. So I would argue that there's probably no one in this room, arguably in the industry, that's done more in whistleblowing and transparency efforts than I have. I broke into the industry whistleblowing the Mt. Gox bankruptcy. I was, I think, a few years ahead, respectfully, of the SEC on Ripple in terms of talking about the overstatements that they had with their market cap and some of the shenanigans that they had with insider transactions and obfuscating some of their marketing materials versus what the reality was as they were distributing these tokens. And I work on this with my team full time, trying to solve some of these information problems. I want to try to keep my remarks relevant to Commissioner Purse's comments, though, and I want to leave everybody with one number if they walk away from the session today, and that's $6 billion. That is the amount of investor capital that is currently locked and underwater because of the SEC's policies towards exchange-traded products. And in particular, the allowance for Rule 144 quasi-ETFs, like grayscales, that trade at a persistent up to 30% discount now versus what their underlying asset value is. Not only that, but you have 5 to 10% costs for the futures-based exchange-traded products. So you've got inferior vehicles that are public that could be corrected with minimal effort on the part of the SEC if these spot ETFs would be seriously considered and allowed. It would create minimal friction for the investors, and in fact, you could close the $6 billion gap overnight because the custodian of the largest quasi-ETF grayscale is Coinbase. So for a retail investor, a professional investor to actually redeem their shares if they were just allowed, it would take about one click at the moment that these products were actually approved. So if we're looking at the SEC's mandate to protect investors, promote fair and efficient markets, and ultimately promote capital formation, the fact that this has not yet been approved, I think, is disappointing to say the least, and I promised that I would behave myself, so I have stronger words than that for sure. But this is the one thing that I think if we could fix as an industry, it would be for the benefit, not only for the folks that are in the industry full time, but most importantly for the investors that are underwater to the tune, again, of $6 billion.
All right. Todd, go ahead.
Cool. Well, thank you, JW, for inviting me to come here. I just want to start off by saying that comments here are my own and not representative of my organization. I hate to do this, but I have no thoughts on the spot Bitcoin ETF. That's fair. So I don't know if we will have a lively debate about that because I don't know. I did want to talk about disclosures really quickly. So in 1946, the Supreme Court decided SEC v. Howey. It provided what I think is a great test for determining whether investment contracts were securities and subject to the securities laws. The Howey test explained that an agreement will be considered an investment contract if there's an investment in a common enterprise with a reasonable expectation of profits to be derived from the entrepreneurial or managerial efforts of others. We can talk about that definition. This four-part test, I think, appropriately includes within the scope of the securities laws those financial instruments for which investors would benefit from the disclosures of the securities laws and excludes those for which investors would not benefit. So if you're investing money and relying on product developers or promoters to create profit, you need information about how those investments will be used in order to decide whether or not you do want to invest capital in that project. The 33 Act governs the security's initial sale and requires an issuer to file a registration statement detailing its senior officers, how it will use the proceeds, records of its prior profits and losses, et cetera. The 34 Act governs the secondary market. It requires securities issuers to periodically update investors on their activities so that in addition to prohibiting insider trading and market manipulation, securities may be bought and sold in a fair and competitive marketplace. So how does this apply to crypto? Back in about 2017, there used to be a lot of ICOs in which an issuer would sell crypto tokens to the public to fund the development of their applications or protocols. The SEC said that these are clearly securities. I think everyone can agree with that. But today, the industry has become a lot more nuanced. VC firms invest in protocol developers by taking a stake in them. Those developers develop crypto protocols, and the protocols will then airdrop or otherwise distribute tokens to users of other protocols and just airdrop into wallets, trying to get them to switch. Holders of these airdrop tokens can have voting rights, the right to receive profits from the protocols, and have the right to sell and otherwise trade these airdrop tokens. So are these tokens securities? I would say yes. I know that there's a lot of disagreement about that. The reason I would say yes is because there are plenty of lower court cases explaining that the Howey test applies to situations where gift recipients sell their securities and make a market. That's SEC v. Sierra Brokerage, where investors expect a profit either from the issuer or from selling into the secondary market. That's Gary Plastic. And where investors may be required to perform some duties, Lino v. City Investing. But perhaps more importantly, the goals of the securities laws would be served as applied to the people who are airdrop tokens or who buy the tokens in the secondary market. So even putting aside the Howey test, just the people who receive these and sell these need the information that would come from a 33 Act filing and a 34 Act filing. The people who are airdrop tokens need information about to help them figure out the price for which they can sell those tokens. And the people who might buy them need information about whether they can buy them and resell them again for a profit. They need this information. Who should be the entity that drafts these disclosures? I think that's the $64,000 question. I'm not sure I have an answer. Many crypto projects are open source. Anyone can suggest edits to an application's code. Usually there is one entity that writes most of the new commits and holds the most governance tokens. Maybe this person could be the one who issues the securities disclosures. I don't know. But regardless, we shouldn't lose sight of the fact that when people buy these tokens, they're investing in a profit-making activity, and they need disclosures. If these disclosures can't be offered, then perhaps the tokens shouldn't trade. In conclusion, we need to find a way to ensure that the people who are buying these tokens get information, whether that's through the securities filings, whether that's through Congress enacting a new statute, or something else.
Thank you, Todd. Jerry?
Well, thank you to W for inviting me here, and thanks to all of you for coming. I'm really thrilled to be here. So look, I mean, just by way of remarks, I think what I can say is maybe give you a little bit of perspective about sort of the view that CoinCenter brings to these questions and these debates in the crypto space. And JW is right. So we are a think tank in the sense that we do plain English, just the facts education. So, if a policymaker wants to understand mechanically how does Bitcoin work, we can explain that. And we do policy thinking where we identify gaps where the technology has maybe outpaced the law. There's a gap, and policymakers are going to want to fill that gap, and so we make, we publish policy papers that identifies alternative ways to fill those gaps and make recommendations. But at the root of what we do is really a civil liberties mission, right? What we exist to do is to make sure that the right to write code and to publish code and to read and run that code and to do all of that privately is maintained, because these are our First and Fourth Amendment constitutional rights. And so when we do our policy thinking, you'll notice that so much of what we do is make sure that those rights are respected in any law or proposal that is put forward on crypto. And what this brings up is, in the crypto space, let me take a step back. The whole reason for being of crypto is to decentralize many of the activities that today or previously took place through intermediaries, right? So a bank, a broker, a payments processor. If you want to expand it to non-financial uses, something like a file storage server or a social media network. These things can now be done in such a way where there is no single provider of these services. That's the whole reason for being of crypto. And in the crypto space, you still have services that are provided by intermediaries and are going to be properly subject to the exact same regulations that any intermediary previously would have been. And you're going to have new forms of doing business where there is no more intermediary, where you just have persons engaging with each other in a peer-to-peer fashion. And so that is really where I think the most novel and interesting questions are, and where the answer usually is there's no sort of prophylactic regulation that you can do, because these are just people engaging with each other. So when it comes to things like ETPs, exchange, centralized spot exchange regulation, lending products, it's appropriate that the SEC and other similarly situated regulators engage, and I hope that they do so in a thoughtful way, engaging with the industry, but totally appropriate. But then you have areas where there's activity where there is no intermediary. There is no body doing anything except publishing code, reading code, writing code, et cetera. And when you get to those spots, really, there probably isn't any place for licensing or prohibitions or any kind of prior restraint on those activities. Now, there are always going to be laws that allow for policing of fraud and the like. You have the FTC, you have other kinds of state attorneys generals have authorities that allow to police for fraud, but there really shouldn't be any sort of prior restraint. And so that's what we focus on. So I'll stop there.
Okay. And I'll say to Jerry's point, I can think of crypto projects I'm not proud of, maybe even some I'm invested in that I'm not proud of. But I can also think of some I'm incredibly proud of. And one example is Airweave, which has a token. It's a decentralized data storage product. And it was used by the opposition in the Hong Kong protests to store their newsletter, their freedom opposition newsletter when the CCP censored them. So very, there are real stakes in this that are non-financial that are important. So thank you. So I'll go through and ask each panelist a quick question, just spur discussion. Feel free to ignore my question if you have something else you want to respond to. This is just to kind of get us going. So Ryan, so at Messari, you've done, and before that, you've kind of served the role of as a journalist, as an analyst, information intermediary. The SEC has kind of a love-hate relationship with intermediaries, right? Think credit rating agencies, think underwriters, investment analysts. So on the one hand, we've heard from regulators, just comply, the law is clear, right? As I try to think that through, past the speeches from Chairman Gensler, how would a crypto project comply with Reg SK and Reg SX, and how would it help us at all? Like at some point a few years ago, he kind of intimated maybe Ethereum is a security or sales of it as security. If the Ethereum Foundation filed, like what would that filing look like? Like Ethereum Foundation owns some Ethereum tokens, but you really learn a lot about the Ethereum network from that filing if you really think through the accounting entity assumption. So what do those disclosures look like? What should they look like? What do we need to know about tokenomics? How does going on Messari better than going on Edgar in that kind of new world? How paint a picture for us.
Well, I appreciate that leading question. But when we started the company, it was with a mindset that regulators were going to come knocking on basically every project that pursued an initial coin offering in 2017. And most of them were pre-utility, pre-network. They were clearly fundraising mechanisms. And there was going to be the need for tracking the progress of those projects and whether they were delivering against their roadmaps or stated missions, and then how those tokens were going to get distributed over time, how they'd be used. Our thesis from day one was that when these networks are in use, regulation of the tokens themselves as securities would very often break the underlying functionality of the network, right? So if the Hong Kong protesters had to file a Form 4 every time that they wanted to store a newsletter, or had to go through a transfer agent, I mean, there's some ridiculous constructs that clearly break down when you talk about this new technology. So we thought about the spirit of existing securities law, and more importantly, of existing consumer protection standards, What we've done since is try to go almost section by section for a quarterly filing, and I think Commissioner Peirce's safe harbor proposal is pretty cleanly mapped to this, and in fact, we tried to triangulate some of our offerings so that it was very much in line. If you look at the work that one of our research teams does internally, it's almost like getting the business description and risk factors for these protocols, but in an open source way, because most of these communications happen in Telegram, in Discord, on Twitter, in Medium, and kind of other public forums. GitHub is a repository for a lot of this information. The blockchains themselves can be parsed. You need a little bit of technical aptitude to be able to get this data and get these KPIs, but if you have the right teams in place that are properly motivated to put this information together, we as an industry can basically come up with the equivalent of generally accepted accounting principles, but specific for this new technology. And in fact, we do that as well. And we're working with dozens of teams on this type of construct. Same thing with governance activities and the equivalent of corporate actions. You know, these are alerts that you can find, that you can categorize, and that you can standardize, mostly in an open environment, an open way, so that people understand what's going on. Now, the important thing here is, are we an intermediary or are we a contributor to this open source information industry that we're trying to operate in and be good citizenships of? The truth, of course, is that we're a little bit of both, right? But my thesis from day one with the company, and where we've tried to steer the company because we think it's in the best interest, not only for our customers, but the entire industry, is this concept of open data paid tools. So a lot of the information that we produce that I just mentioned is open and free for investors, for enterprises, for end users, and it's one of the top areas that people have come to rely on us for over the course of the last few years. Obviously, some of the tools that we have, the alerting infrastructure, our data API, that's more of like a traditional data company. But I think the industry will be healthier if more companies and regulators hopefully can rally around this as a standard. Because the thing that Commissioner Peirce got right, especially with the safe harbor, is at time zero, any time that there's even the kernel of an idea in someone's head, it's going to be centralized because it has to start somewhere. Over time, it will become decentralized. And what I think the safe harbor does is it gives us a little bit of a time period to actually get this right and allow innovators and the folks that Jerry's trying to protect at Coin Center the time to kind of do the right thing in accordance with the spirit of existing regulations and laws, but also account for the fact this is a new technology and these truly are decentralized systems that might not necessarily at scale have a centralized disclosure.
Good. So Todd, I want to talk about a couple of things. Two thoughts that you've spurred for me. One, feel free to ignore the first one because it might just be kind of securities lawyers nerding out. And the more generalized audience might not be as interested, but this is FedSoc, we've got a lot of legal audience. So the question, I'm fascinated by the question of, are airdrops securities? Because this is really at the heart of how we test application to where we are now, right? A lot of projects launch in this way rather than the old ICO method that was a lot closer to how we. Case law, very sparse. And the only case law we have that I've found in the treatises, and I found a few treatises where, old securities law professors say, oh, sure, airdrops are securities because, look, spinoffs were securities 20 years ago, so that's fine. Not enough for me. I'm not convinced because, in part, that old case law is about spinoffs of subsidiaries in which the parent company held stock. So we've already decided it's stock, even before anything happens. And the question is whether distributing that stock is a sale of securities. Courts have decided it's a sale. But we're in a different place with airdrops because we don't even know whether it's a security yet. And I think airdrops have gotten better than they used to be. It used to be a few settlements with the SEC involve someone who, gets an airdrop in exchange for doing some very specific things. So it seems like they're kind of being paid to do it, right? Now the airdrops are after the fact. The airdropper, so to speak, takes a snapshot of the blockchain and looks at things, activities that seem to be people involved in the chain or in related chains that might be interested in our chain, but there's no quid pro quo. So it's a much closer case. I don't know if you want to debate that a little bit with me, or airdrops or securities. We've only got a couple of settlements at this point, not much. And the second question, I think we have a lot more common ground than either of us like to admit when we get in our Twitter debates.
I think that's right.
So look at one of the interesting things about Commissioner Peirce's safe harbor is it's called a safe harbor, but to get into the safe harbor, you got to do a lot of stuff, right? There's a laundry list of stuff you have to disclose, a lot of stuff. And the Reg X proposal that's kind of a fork for safe harbor that I'm really proud she mentioned. Really great work by the folks at the Lex Punk Army. What a great name, right? Their safe harbor has even more requirements to get in. Like if you're a whale, crypto whale looking to dump, you hate the Reg X proposal because it's not in your favor. It doesn't help you at all. It's a very long-term vision and an ecosystem supportive vision to comply with that Reg X idea. The SEC has done exemptive relief in the past. When pension funds start voting a lot and talking to each other, there was a big problem here. We're all deemed to be soliciting proxies just by talking to each other as pension funds. SEC comes along and says, okay, we understand it. We'll do a lot of exemptions for pension funds to help them talk to each other about proxy votes. Internet comes along. It took the SEC a while to say, okay, fine, you can distribute proxies via this new email thing. It took them a while, like well after email was a thing that we were all doing. They eventually came along. Okay, fine, CEOs, you can say something about your company on Twitter, and we won't call it a Reg FD violation. That was like 2010 before they did that, right? It took a while, but they came around. I think we all know they're going to have to come around on some kind of crypto-specific guidance and even something we might call an exemptive action. But an exemptive action that has a laundry list. Meet me in the middle here. How did we get there?
So I agree with you that I think exemptive relief is going to be necessary to get to a place where people are willing to register these tokens and that they're going to be able to trade on securities exchanges or crypto non-securities exchanges or something. I am sure that exemptive relief is going to have to be a part of that. I am sure the SEC is going to have to come out with guidance about what it thinks of the Howey test and where it imagines the bounds of its authority. And I think the SEC needs to come out with this and say, this is our understanding, this is the bounds of where our enforcement actions are going to go. And if you don't like it, you can sue us, and we'll have a court figure it out. I think that's what everyone here is looking for really some good, a good answer of what is a security and what is not. I've also heard folks say that they would like the SEC to write a rule about how it interprets the Howey test. Because the Howey test is a Supreme Court made rule, I don't know if the SEC can change that through rulemaking, but that is something that I'm sure people much smarter than me can figure out. As for our airdrop securities, I think that they are, and I think that they should be considered a security. We need the securities law disclosures. If investors want to buy and sell these things, they need the securities laws disclosures. And I think that even if an airdrop doesn't meet the exact investment contract definition, which is what the Howey test was about, it's entirely possible that we could call these things shares in the protocol. My understanding is the Supreme Court has not, there is still some room for the SEC, or for the courts or the SEC to decide, this is what a share is, this is what a share isn't. And it's entirely possible that they could get there. I don't know what the SEC is going to do. The commissioner is shaking her head no, but yeah. But I'll just reiterate. I think that the disclosures are necessary, and either that comes from the securities laws or that comes from a new statute that comes from the new commodities laws that Congress creates. The end thing I want to get across is just that investors need this information.
Just one point.
Yeah.
I think we agree on that point. What I'm asking is, would you be okay if we work on it together if the disclosures come as part of the exemption? The laundry list of disclosures required, because that's what the commissioner's proposal in Reg X. Can we do disclosure via, because a lot of SEC exemptions they don't seem like exemptions really when you read them because they have a long list of stuff you got to do, right? Would you be okay with that approach? Or at least open to talking about it?
I would definitely be open to talking about it.
Okay, good.
Yeah.
Jerry.
If there's one thing that I could add to that, because we've looked at this for 5 years as a company, right, as a model, it is extremely difficult to get any protocol to be open-minded about making disclosures on behalf of an entire community, if you're like a foundation, for instance, because there's strong disincentives to make yourself look as if you are a centralized party capable of making these disclosures. And it's a little bit of a reflexive argument, but this is important because the biggest opportunity to regulate some of these players, and one of the biggest information gaps right now in the market, is who holds the tokens, because who holds the tokens ultimately is what's going to drive whether there's significant selling pressure in a market environment like we've seen today, or if there's major governance decisions, who's actually going to hold the voting power to push through protocol changes in some of these decentralized systems. That's something that we could do today. You could go to the regulated funds that are above a certain threshold. You could go to the exchanges that already work with all these regulators, and you could understand where the thresholds of ownership, who actually owns material stake in these markets, and regulate the edges instead of trying to pigeonhole one or two entities that might be at the periphery at some point based on the evolution of a protocol into making a disclosure on behalf of an entire global ecosystem.
Does that work though at the initial stage, at the initial?
That's I think the safe harbor would absolutely help in that interim stage, right? And so you could apply for some exemptive relief, a safe harbor during the process of decentralization. But we've also got a problem where we've got thousands of assets that are already out the door right now. They're going to have to be come into compliance, and there's going to be some remediation in place. One of the best ways to do that and start to chip away at some of these information asymmetries would be to look at the largest investors that are above the $150 million threshold, for instance, or the exchanges that are already regulated, because of those are the central choke points as custodians of these funds.
There's just no way around it. One of the problems we'll always have is kind of what large investor disclosure, will disclosure, if they're dividing across multiple wallets. Anonymity is a twist we don't have in regular securities disclosure.
Well, you can do it as a regulator, right? It's easy for a fund or an exchange to obfuscate that from public view, and in fact, it's probably going to be the norm. You know, if you're Fidelity, you don't want to accidentally disclose that one of your material investors executed a transaction, and then through blockchain forensics, you were able to track that was a major counterparty, that was a major specific client. That would be a big no-no, and that's an argument for some privacy features on blockchains. In fact, like that suggests that you're going to need regulation at the edges and at the investor level, where you might never get this information because you might not be able to procure it or ultimately use even forensics to get this information, since you can pass these wallets through tumblers or ultimately use other privacy preserving techniques at scale.
Jerry, you want to jump in?
Yeah, I just wanted to say, I mean, I'm sure when you asked the question, are airdrop securities, it's kind of a shorthand that you're using, because an airdrop is just a technical means of distributing a token. And
I guess specifically, does the airdrop count as sale of securities?
Right. And so, we just need to be careful that we don't just say that any application of an airdrop would necessarily lead the thing to be a security, because I can imagine writing a smart contract that is not updatable, that does some function, maybe it's a random number generator. I airdrop the tokens to a selected population of folks, and then they can use that airdrop to do whatever the function of the smart contract is, and maybe those things start trading for value because that thing is valuable. I'm not sure, what the application would be there. And
yeah, I don't think that's a security, but there are some people who argue that just because you anticipate future value by the creation of a secondary market, you are selling securities even though you're giving them away for free.
Yeah, good luck.
Yeah.
The other thing I would say is that I'm not sure, I'd be curious to know, what the threshold for guidance would have to be for it to be satisfactory, because we've already seen guidance from the SEC, right? We had staff guidance about how they do Howey analysis when they look at digital assets, and it still leaves, you can still find corner cases within that, which is why I like something like the safe harbor, because it allows for a period where any ambiguity is kind of put off so that it can be addressed before there's another hard look that's taken.
In interpreting its own legal authority, the SEC is always very generous, always very many times generous. But I have a question for you, Jerry. So one of the theoretical constructs behind the Patriot Act, and people don't think of it this way in the media, but the Federal Society is a debating society. If you're not familiar, that's what we are. And our debates are quite serious. I first came into FedSoc during Patriot Act days, and those debates between libertarians and conservatives were hot. They still are, and they should be. They're professional, but very impassioned. So there's this kind of implicit bargain behind anti-money laundering BSA that's kind of been read in by courts that, like, once you use the banking system, you've kind of given away privacy because it's part of the privilege of third-party custodianship of your assets. So crypto is redefining that bargain. And you're defending that redefinition of that bargain, or is it not? Is the bargain new? Is it a post-AML world that we're moving toward?
Well, so a couple things. So the Bank Secrecy Act, which is what creates our anti-money laundering regime, was challenged on a constitutional grounds, right? Because what it basically does is that it requires financial institutions to turn over information about their customers, regardless of whatever contract they have with their customer, and without a warrant. Just on a systematic basis, you have to turn over this information to the government about your customers, and it's a surveillance requirement. And this was challenged on constitutional grounds, right after the BSA was enacted in the 60s. And the court said that it was constitutional on very narrow grounds, right? And what the court said is that there is something called a third-party doctrine, which says that if you voluntarily hand over information to a third party, and that third party needs that information for a business purpose. So, for example, a bank needs to know who you're writing a check to and the amount in order to do the business, right? If you're doing that on those very narrow grounds, because you've voluntarily given up this information that the a person you're giving it up to, the financial institution you're giving it up to, needs for a business purpose, you've given up your expectation of privacy. And so there's a third-party doctrine exemption to the traditional Fourth Amendment warrant exemption. Okay, so add crypto to the mix. When you add crypto to the mix, and I'm sending you a Bitcoin transaction from my self-hosted wallet to your self-hosted wallet, we're not implicating a financial institution at all. And it's like as if I hand you a $100 bill, you know, and when I give you a $100 bill, there is no BSA requirement that we report that. There's no financial intermediary that is subject to the BSA there. So, so I would say that it's not so much an undermining of the BSA as it is just sort of orthogonal to the BSA in large part.
What about, though, so far, been a few charges involving money laundering that involve something else. It's a tack on to something else. So let's assume that some of the cases involve somebody who did a bad thing. I don't know if the charge was appropriate or not, but maybe did a kind of a bad thing. That was kind of a felony, right? So money laundering basically is if there's a predicate act and you're trying to conceal the proceeds of the felony, money laundering is pretty easy to kind of tack on, right? So there are people that use technologies in crypto that are innately anonymous by their nature. So we've had money laundering charges just because post-bad thing we have a recent charge where pre-bad thing you used privacy technology. What do you think about that? I mean, most of those cases have settled and it's kind of blustering. But what do you think about kind of overcharging of money laundering as a threat to what you're talking about?
So this is a threat to what I'm talking about?
As a threat to the post-BSA or non-BSA vision for blockchain transactions?
I mean, it sounds to me like you're asking me what I think about money laundering as a crime, period, right? Because it doesn't really matter what technology you employ in the money laundering aspect that you're going to be charged with as a tack on, right?
It just feels like it's expanding beyond the really difficult things you have to do to money launder cash versus just using Samurai Wallet on my app, which is a lot easier.
Yeah, but if you're doing the things that would give up, that would meet the elements of a charge of money laundering, you're money laundering, whatever technology you happen to be using. And the question is, should we have money laundering as a tack-on crime?
Maybe that's the next FedSoc panel. Let's get ready for questions. As we get ready for questions to come up, I'll ask just a question of the panel. There's a DeFi developer, Andre Cronje, who's been talking recently about a kind of a view of crypto, the crypto regulatory sphere. He was, for a long time, was a DeFi developer, kind of way out there in the unregulated space, and is more recently kind of looking to develop in the more regulated space. Anyway, he kind of describes it as this, that there will be the safe part of crypto, where your grandma can onboard to a little bit of crypto investing. Then they'll be stretching out into the increasingly unregulated, more kind of Wild West, Badlands sphere of DeFi and such. And that's an accurate portrayal of how the West was kind of developed, right? And by the way, I don't see anybody sauntering toward the mics. You all should be sauntering toward the mics. But what do you all think about that as a vision for the intermediate term, at least? That there'll be the unregulated Badlands of DeFi. There'll be the more regulated sphere as a way this kind of develops, onboarding of traditional retail through regulated products and TradFi partnerships with crypto, and then evolution of code-based things that are very hard to regulate even if you try. They've got meat space interfaces, but the actual protocols themselves are just distributed decentralized technology. Is that, let's stay in the same order. Ryan, what do you think about that? The Badlands, the safe St. Louis, Dallas versus Lonesome Dove, kind of Wild West?
I mean, I think that's more or less right. I think you have to preserve the Badlands just from civil liberty standpoint. And if you think about the folks that are going to be committing code to the Badlands, if it's strictly peer-to-peer code that anyone can run, if the individual users so choose to run that technology, I think it should be fair game. Now, the reality is not many people are going to use that by default, right? They're going to use services, they're going to use products that abstract away all the technical complexity of these assets. And so the reality is you're going to see, regulated edges that make the underlying protocols trivial to use. Perfect example is email. Anyone can use SMTP. Most people in this room probably don't know what SMTP is. They know what Gmail or Outlook is. Those are going to be the clients that actually deploy this technology and wrap it in a way that is going to be safer and easier for folks to send emails. I think the same is going to be true for DeFi, and I think DeFi, as a result, is ultimately going to transform the back end, not only of most financial services, but of most of our modern tech stack. That's what's so exciting. I think that's the opportunity ahead. And because that's the size of the opportunity, I think it's a little bit crazy for people to expect that everything is going to be the Badlands. We're going to need some regulated edges and some sophisticated standards, whether that's through legislation or smart rulemaking that help the regulated edges do this in a way that's thoughtful but ultimately compliant, and they can be a little bit more proactive about that.
Yeah, so I think that just with any technology, anything, you are going to end up having some of those Badlands. That being said, I think that most of DeFi governance tokens are securities. I think Congress made the explicit intention in the securities laws that we want to protect retail investors by putting in place these disclosure requirements, putting in place the trading, the regulation of exchanges, things like that. And I think that to the extent we're talking about retail, I do think that they need to be protected. In the securities markets, has been created the public markets versus the private markets. I think the private markets are far too big, and I think the SEC really should shrink them and make sure that everyone receives the disclosures. But I see that there is a role for private markets to some extent. I imagine the same thing could happen here with DeFi. I'm not exactly sure where the line is, and I'd have to think about it more.
And it's a little bit of a catch-22, isn't it? That if you tell crypto, well, just raise money with a Reg D offering. At the same time, some at the commission are trying to shrink the size of the Reg D offerings with changes to the accredited investor definition. But I take your point.
And I think most people raising money for DeFi should do a traditional securities offering.
All right. Well, Jerry?
So, I mean, the justification for the regulation that we're talking about here tends to be that there's information asymmetry of some kind that we're trying to cure with these disclosures and other kinds of regulation. So if we're instead talking about having some other part be true peer-to-peer networks of open source software where the connections and everything is completely transparent, and you have smart contracts that are auditable by anybody who can read the code, then you don't have the information asymmetry problem. And so no regulation is necessary, and so I wouldn't call that a bad land, right? I would call them an alternative way that we should encourage. And I think Ryan's right. We're not going to see that be, the place where most of the activity happens immediately, but you can imagine that growing.
But I disagree. I think there is an information asymmetry. You do have some people who were the ones who created the protocol that's running. They know the ins and outs of potentially very complex software. And there are other people who have been airdropped a token, and they need to figure out what they're going to do with this. Do they participate in helping govern the protocol, or do they sell it off to a third party? One of the great things about the securities laws is Congress said we want companies, registrants, to file pieces of information providing pretty good information that folks need to have to be able to adequately value these securities. The same kind of thing should happen with DeFi. Of course, you will always someone will always have more information than someone else, but we at least need these standardized disclosures that have pretty sufficient information for people to adequately appraise the values of the tokens.
So, as I said earlier, whether any particular use of an airdrop would constitute a securities of facts and circumstances, things we'd have to go look at it, right? Like who's doing the airdrop, what is their continuing relationship with the project and the tokens, et cetera, et cetera. But, let me finish.
Sure.
The fact that you have a developer who, by virtue of being the developer, has more information about the software and the system, because just they built it, they know the insides and outs, as you say, as long as the smart contracts and everything is completely transparent and open source, then by definition, they may have more experience with it, but they have no more information than anybody else in the world who can look at that smart contract. And if, as I said, you have peer-to-peer networks that are transparent, open to anybody, and the source code is open source. And by the way, what I'm describing here is what Commissioner Peirce has as the requirements for her safe harbor, or among the requirements for her safe harbor. As long as you have that, there really is no information asymmetry, even though somebody might be more experienced with it.
Two things. One, nobody reads SEC filings. Two, the financials on the blockchain can't be manipulated or forged. They can in a public securities disclosure framework, right? So I think those are two really, really important facts. And the whole concept of quarterly reporting is actually an anachronism when you can look day to day at the activity that's happening on a given public blockchain.
Yeah, but we see a lot of exchanges where the trades happen off-chain. You can't look at the transaction history of something that is off-chain.
Yeah, but that's exchange regulation. That has nothing to do with the underlying protocol.
You're still valuing the underlying token based on the transactions that everyone sees. This is part of securities regulation. This is part of markets regulation.
There are some exchanges that would like to register as under Reg ATS.
Mm-hmm. They've been hitting a wall, just like the Bitcoin ETF. I mean, would that be a solution to what you're talking about?
Listen, I have no idea what the SEC is doing or what the commissioners have planned. I got to say, I don't know the answer to that. I mean, what I do think, and I'll say it again, is I think it's really important to have a document where someone can go to look at all of the information they need to adequately assess the value of a security. There will always be additional information out there you can find, but I think, the SEC and the markets just need this standardized information so that people don't have to go around, scouring, hidden parts of the internet to figure out what the value of these things are.
Nothing's hidden.
I use that.
I'm going to give you a demo after this.
Got it. Right. I know how the internet works.
And I'll grant you that I've approved a lot of smart contracts, and I don't know anything about code. But I rely on intermediaries and the reputational sanction of intermediaries. Sometimes that works, sometimes it doesn't, but I think that's probably how part of this will have to, no doubt, evolve. We've got some questions, so why don't you go ahead and please.
Thank you. And Ryan, something you said kind of spurred a question in my mind when Commissioner Peirce was talking about the two alternatives of a surveillance agreement or some demonstration of sort of uniqueness in the underlying product being on the immutable, transparent blockchain. I'm wondering, to what degree the industry has been trying to drag the SEC along in terms of the uniqueness prong or option by the very nature of the product, and how those conversations are going or how they're evolving, and if there's been any progress in that regard.
I'm actually not a lawyer, like I said, so some of the other folks on this panel might be better suited. Maybe Jerry has a thought or two on this. I mean, I think the big issue is we can point to the blockchain transactions all day long, but at the end of the day, these spot ETFs are going to price off of centralized exchange feeds. The question is whether there's going to be anomalies between Coinbase and Gemini and Kraken, which fit pretty cleanly under U.S. regulatory framework because they're based here, or whether the SEC is going to require full international coverage of 90% of the daily traded volume before they're satisfied that there's sufficient lack of market manipulation, and whether all of those exchanges need to enter into surveillance sharing agreements.
I couldn't add anything more to that other than to say that, from what I've observed, just as a spectator on the sidelines, every time it seems that there's an applicant who makes a filing answering the SEC's previous objection and saying, oh no, well actually now we have custodians, now we have this, now we have that, there's just a new objection that's put forward.
I mean, I think the primary objection is, at what point is a 10 basis point spread between two international exchanges just irrelevant compared to the 30% discount that public market investors are currently facing with these inferior products that are allowed to list and have no path to redemption short of an ETF approval? That's really the SEC's mandate. It's like the magnitude of those two differences is laughable on its face. And anyone that you kind of explain this to, because they are technically complex products, but anyone that you explain this to can see that the SEC is using market manipulation as an excuse and failing catastrophically when it comes to investor protection.
Good afternoon. I'm pretty new to this, so I apologize if my question isn't super specific. But last week, Senator Lummis, in talking about her new bill, said that we're trying to just fit the digital asset world into our current regulatory framework. To what degree do you think that's a good idea? Or is this an opportunity to create a new framework for new types of assets?
These aren't new assets. I mean, honestly, things like Bitcoin and Ethereum are commodities, and so derivatives based on them, would be regulated by the CFTC. Tokens that are issued in certain ways are going to be securities. So I don't think we need to invent some new category specific for digital assets. I just think that we need to be smart and clear about what bucket particular things fit into.
Yeah, I agree with that. I think these things are commodities and they can be securities. I don't know exactly what you call an NFT, but I think the Federal Trade Commission has authority to regulate them. I think the CFTC or some agency needs authority over the commodity spot market, because right now no regulator has full regulatory authority over that market. But other than that, I think maybe some tweaks around the edges.
I think the technology is very, very different. I think that we should be looking at the spirit of the law, and we should be looking at this as new technology and how do we adapt to it. And I know that's inconvenient because it requires a little bit of a cooling off period and maybe some years before the infrastructure can be developed that will satisfy regulators' desires. But fundamentally, I think that trying to regulate and seek disclosures from a central party that's responsible for the maintenance of the protocol is the wrong approach. And the right approach is looking at the major holders of the assets, and you can do that by looking at the regulated edges and the investors and custodians that actually hold these things. But that, I don't know if that's going to get worked out in the Lummis-Gillibrand bill or what that path is. I just think existing securities law, if we're trying to jerry-rig tokens to that 90-year-old framework that was written pre-computer, it's going to be pretty difficult.
Yeah, I just to jump in, I think this technological uniqueness is part of what makes these assets very morphable, and regulation is not designed to deal with morphable assets. I mean, just outside of law, just trying to think about valuation issues around these things is very complex because just take Bitcoin. Bitcoin has attributes of store of value. It has aspirations to be a currency, and it's in some ways used as payment, but limited so far. And some of these have attributes of both of those things and also some utility value on the network, and also some attributes as traditional security. So they're very morphable in that way and depend in part on how the individual user is using them. I like the energy behind the new bill, and I want to salute it. I have some concerns about that particular Title III of that bill, and the fact that it takes. I'm a big fan of Commissioner Peirce's, not just because she's here, her safe harbor, because it's simple, and I think that has to be simple. I think that's that the design that's in the bill is overly complex, and that complexity can bring back some of the interpretive questions that got us to some of the difficulties we have with Howey now. So that's my concern there. I'd keep plugging away at that and working with the staff on that particular title of the bill. But I love the energy behind it, absolutely. You have a question?
Thank you all for being here today. So I work for ALEC, the American Legislative Exchange Council. So I was very intrigued by the title of today's presentation. We're going to be considering a model policy addressing crypto regulation at our upcoming conference. I guess I'm interested in getting some perspective on why there's so much interest in the states regulating cryptocurrencies rather than determining it at the federal level, just because I know for businesses it's quite expensive to comply with all the state-based regulations. Thank you.
Wait, sorry, so was the question
state versus federal regulation? And what?
More interested in state-based regulation of crypto assets.
Why industry is more interested in state-based?
Yes, just because my impression, like I understand why state legislators are interested in determining it by their state, but then for some, I'm surprised that so many industry leaders are interested in it being determined by the states instead of the federal government.
The current federal regulatory regime is hostile, so we'll fight anywhere that we need to until there's more common sense, is the short answer. That's not the lawyerly answer, that's why I can say it.
Yeah. I'd love to talk to you more, though, about state competition. In a prior life, I was supportive of the FinTech Charter competition idea, not only the federal FinTech Charter, but also state-based FinTech charters. And the issue, the problem with banking and financial chartering reaching the ideal of interstate competition for chartering, the way that LLC chartering enjoys the competition, is the ability to have mutual recognition is limited by the fact of the FDIC's kind of oversight. If the FDIC is supportive, then it's great and you can make it happen. If they're not, then it's not possible. So, but I'd love to talk more about that because Wyoming started to get in the game, a few others, and I'd love to talk more about that because I think it has promise, particularly for using limited purpose bank charters to facilitate things like stablecoins.
I mean, also just, this is not directly answering the question, but I think that when we're talking about national or even international markets, national or international transactions, I think it's important to have federal regulation so that you don't have just state by state regulation. You know, one of the, I think, great things about the securities laws is that if you are selling a security interstate, you have to follow one set of rules as opposed to 51 plus different standards. And again, I think a lot of these things are securities. It seems like we may get federal commodity regulation soon. So I think that the federal regulation is the way to go.
I think that some of the state-by-state issues are not necessarily about securities law in particular. Some of it's about legal incorporation, right? So how do you think about these protocols? Are they LLCs? You know, there's a pretty big push to regulate these entities as unincorporated entities, unincorporated associations, that's right. Unincorporated associations, and so you might need Wyoming, Colorado, Texas, some experimentation at the state level, which is exactly how the LLC ultimately came to fruition, 30, 40 years ago.
So there's been some persistent frustration with the regulation by enforcement approach, and particularly with the regulation by settlement agreement approach. And it's been suggested several times, including by this panel, that if someone would just take the SEC to court everything would come out, positions would be crystallized, and at least a court would settle it. The core of my question is that naive? And I'll give a specific reason why I asked that. That was argued for the Ripple matter, which is still going on. And the complaint in Ripple said, offered two potential interpretations. Either XRP itself is a security, or XRP is a token and you layer on top the promises made by the various Ripple executives of number go up and continued development and stuff like that. And that package is a security. And industry observers have commented on this many times. Ripple has said, well, which one are you arguing? And so far as I can tell, the SEC has been absolutely unwilling to clarify its position. So I'm wondering if you could comment on that.
I have some thoughts on the Ripple litigation. I'm actually doing a panel at 7 o'clock, a podcast at 7 o'clock tonight. You all should listen, with John Deaton, who's been very involved in that litigation. Folks, there's a lot to say there. Sometimes court challenges against agencies can go against you. Sometimes you can get the opposite answer you want. That's true. That particular litigation, I think, probably will not get the far-reaching reinterpretation of Howey that I'd prefer. It'll probably be either settled or outcome on other grounds. Although I still contend that even though on a circuit-by-circuit analysis of Howey, which is what most lawyers will do for you, the SEC has a lot of discretion and the odds are in their favor. But if this case were reconsidered by the Supreme Court today, they had a chance to take a look at the original language in Howey. That language is pretty strict. I won't belabor it, but there are some qualifiers on that language that are pretty strict that have been watered down a lot by circuit courts over the last couple of decades. So maybe there's a chance there, but generally speaking, APA challenges are probably the way to go to get some clarity, and I have a lot of thinking on that, but we'll keep that discussion going.
I think that because the Howey test is a court-made test, again, I don't really know the extent to which the SEC can weigh in here. It definitely has enforcement discretion, but the extent to which it can decide what is an investment contract or not, I don't know. I think that court-by-court challenges is probably the way that we are going to figure this thing out. I think right now the big one appears to be the Ripple case. I think it will take a while for that case to wind its way up through the courts, potentially up to the Supreme Court. I think it makes a lot of sense to file in a bunch of different districts in a bunch of different circuits and just have this kind of bubble its way up.
Yeah, I agree with Todd. I think that having this as a judge-made law, and the only way we're going to get real clarity is by getting more judge-made law, more common law kind of develop around this. Now, I agree with Commissioner Peirce when she says, we don't want to have enforcement, regulation by enforcement where you wait until you have some big, massive case that you then have a settlement, and that becomes a template for the whole industry. But at the same time, I wish more in the crypto industry would go to court, right, when faced with an SEC enforcement action, because that's the only way we're going to get, ideally you can have the SEC and parties who wish to do something that is ambiguous or that implicates the law in some way come to an agreement of how best to do that, maybe using some of the SEC's authority to exempt. But short of that, let's go to court. Why not?
I will also,
I was just going to say I've been advised publicly not to talk about my interest in suing the SEC. But I do think that Grayscale, the spot ETF issuer that we've spent some time talking about, is probably in the best position of anyone historically to do this very publicly, because they're from a position of strength, number one, given how underwater the assets are in the public markets, and this is truly in the best interest of investors. And number two, they win in either scenario. Either they push through a spot ETF, or they lose, and they have about $1 billion of annual revenue that's basically locked in perpetuity, as long as these are Rule 144 vehicles where there's no redemption mechanism. Actually, it was $1 billion, now it's about $500 million, but still, that's not bad for a product that's on autopilot. So I think they're in great position to do this, and I think it would be a service for the whole industry. Hopefully they win.
I was going to add, just to advertise myself really quickly. Last year in the Administrative Law Review, I published an article where I talked about how I think agencies should do more articulating policy via adjudication cases, and there are democratic ways you can do that. I think, as Commissioner Peirce said, bringing cases to articulate this without getting input from the public is probably a problematic way to do it. But I do think there are ways to get public comments in these adjudications through amicus briefs and things like that. And I think the agencies, including the SEC, should really consider that as a model. Thank you.
I foresee a long future of us doing opposing amicus briefs, and I think it will be fun.
I think it'll be fun.
Question?
Hey everyone. Ryan, this is, I guess, initially at you and then to the broader panel. So there's been a lot of talk about crypto winters, and, or as Andreessen Horowitz, I think, aspirationally terms them, price innovation cycles, where you have, at kind of its essence, huge spikes and then troughs where kind of interests goes away, and during those times of diminished interest, there's real innovations and they lead towards the next run-up. During this one, notwithstanding the kind of broader macro environment, what are some of the opportunities that you see that regulation, when brought appropriately to the space, can provide and kind of help bring some guardrails and guidelines? And what are some of the risks where potentially overregulation can stymie some of that innovation?
That's funny. Yeah, that's like the pump up song for us down 70%, right? Yeah. I think there are a couple things to remember. One, every cycle it's a much higher low typically, so that period of consolidation is from a significantly higher base. This is too much. There's one important byproduct of that, which is that regulators, institutions will lose interest, right? And this has almost been like a cloak of armor for the industry in previous cycles. It's like things are going sky high. This is a bubble, it's gonna end badly, and then it kind of does end badly. But there's no contagion necessarily. Regulators and policymakers have very short attention spans. The media helps perpetuate this narrative because then they pile on and they say Bitcoin is dead, crypto is dead. And the next thing you know, we get to hide in plain sight for another few years of an installation cycle, right? So I would love to see more thoughtful regulation and a lot of collaboration with policymakers in this cycle. But, in a prolonged period of winter, if the end results of those conversations are going to be negative, I think the industry has historically shown an ability to kind of retrench and batten down the hatches to basically avoid the worst, right? So survive, advance, delay until we have a little bit more sophistication on the part of the policymakers that are going to be driving this agenda forward.
I think that was the Crypto Defense Lawyers Conference next door. Anybody else have any closing thoughts? Let's do one, just last word from anybody else.
This has been great. We have much more, I think, in common than you would expect from seeing us go at it on Twitter.
All right, thanks everybody. Thanks to our great panel for discussion.
And thank you to Commissioner Peirce.
Thank you, Commissioner Peirce.
Thank you.